Thanks for tuning in to your daily dose of quick real estate updates, local housing trends, and market data, plus tips, tools, and strategies to help you buy, rent, or invest with confidence. You're now getting ready with RealiCare Reports, powered by the innovation team, Cami and Rex. Now go grab your favorite morning beverage, whether that's coffee or tea, and let's enjoy this episode.
Welcome to the deep dive.
Great to be here.
Today we're jumping into something pretty meaty, the Fed's interest rate moves and, how they actually shake out in the housing market.
Yeah, it's a big topic. Lots of connections there.
We're working off a Bankrate article that just came out yesterday, May 7th, 2025. It's called Federal Reserve Interest Rates and the Housing Market.
A very timely piece.
Exactly. And our mission, for you listening, is to sort of cut through the noise. We want to figure out what the Fed holding rates steady now, plus their cuts late last year, actually means.
Right. For mortgage rates, affordability, the whole housing picture.
Precisely. So, let's get into it.
Okay, so the Bankrate article kicks off by mentioning the Fed's latest meeting, their third this year. And the headline is, no change. They kept the benchmark rate right where it was.
Okay, holding steady now, but that came after some action late last year, didn't it?
It did, yeah. End of 2024, they actually cut rates 3 times. There was a 0.5% cut in September.
0.5%, okay.
Then 2 smaller ones, 0.25% each, in November and December.
So you'd naturally think, okay, 3 rate cuts.
Yeah.
That should mean mortgages get cheaper.
Right.
That seems like the logical next step.
You'd absolutely think so. Seems straightforward, lower Fed rate, lower mortgage rate.
But I sense a but coming. The article points out something else happened.
Exactly. Here's the twist. The article notes that mortgage rates actually ticked up in January 2025, right after those Fed cuts.
Wait up. How does that work? What's driving that disconnect?
Well, it's because the Fed doesn't have, like, a direct dial for mortgage rates. It's not that simple. Mortgage rates tend to, follow the yield on 10-year Treasury notes more closely.
The 10-year Treasury. Okay, explain that link a bit more.
Think of the 10-year Treasury yield as a sort of benchmark for long-term investor confidence, or maybe lack thereof. If investors are worried about inflation staying high, or the economy growing faster than expected, or even government borrowing.
All those big economic factors.
Right. They demand a higher return on those Treasury notes.
Yeah.
That pushes the yield up. And since mortgages are also long-term loans, lenders tend to price them based on that Treasury yield.
I see. So stuff happening in the broader economy, like stubborn inflation in early 2025.
Exactly. That, plus strong growth and maybe some worries about government debt, all push Treasury yields higher.
And that's what pulled mortgage rates up, even though the Fed had just cut its own rate.
Precisely.
Yeah.
So the Bankrate piece concludes, for mortgage rates to really drop significantly, we need to see inflation get back on that clear downward path towards the Fed's 2% goal.
Okay, that makes a lot more sense now. It's not a direct line from the Fed to your mortgage quote. The bond market plays a huge role.
A critical role, yeah.
So tracking inflation becomes just as important as watching the Fed's announcements, maybe even more so for mortgage rates specifically.
Definitely.
Now, the article also looks back a bit to 2022, when the Fed was doing the opposite, hiking rates pretty aggressively to fight that inflation surge. What was the impact then?
Well, those hikes in 2022 definitely pumped the brakes on the housing market activity. You saw home sales drop off, fewer transactions happening.
Okay, that part makes sense. Higher rates, fewer buyers, slower sales.
But here's the interesting bit. Again, even as sales volume went down, home prices actually hit record highs.
Record highs while sales were slowing. How?
It just shows that interest rates, while important, aren't the only thing driving prices. You've got supply or lack thereof.
Right, the inventory issue.
Yeah, overall economic health, demographics, lots of factors swirling around. So predicting the exact effect of Fed moves on house prices is, it's tricky, really complex.
It really is a puzzle. So let's bring it to the present or near present. The article mentions data from March 2025. What did that snapshot show?
Okay, so March 2025 data. The nationwide median price for an existing home was $403,700.
$403,000. How does that compare?
Well, it's up 2.7% from March of the previous year. And interestingly, it's still pretty close to the all-time peak price.
Which was when?
The article says that was $426,900 back in June, presumably June 2024.
Wow. So even with everything the rate hikes, the slower sales prices are basically staying near record levels.
That's the picture, yeah. Sales volume is down, but prices are holding firm, very elevated.
It still feels a bit strange, doesn't it? You'd think those higher rates would have to run prices down more significantly. What keeps them propped up?
Well, like we touched on, that limited supply is a huge factor in many areas, just not enough homes for sale.
The supply-demand imbalance?
Exactly. And also, basic demographics, people forming households, needing places to live. That underlying demand doesn't just disappear because rates go up.
Okay, so structural factors are keeping prices sticky. Now, the article shifts perspective a bit, looking longer term. It suggests that historically, the housing market is actually pretty resilient to rising rates.
Yeah, that's a key point they make. History shows that people often buy homes because of big life events, like, getting married, having kids, new job, relocating, stuff like that. Those needs often override whatever the current mortgage rate is.
So life happens regardless of the Fed.
Pretty much. The article points to the 80s and 90s when rates were much higher than now. People still bought houses.
I remember hearing about those crazy high rates back then.
And even during the 2004-2007 housing boom, rates weren't exactly low, but prices kept soaring.
Right.
So the message seems to be maybe this current slowdown isn't the start of a crash, but more like a normalization, the market catching its breath after being super hot.
A return to something more sustainable, perhaps. That historical view is useful. But let's talk about now. For someone trying to buy today, affordability is the word you hear constantly. How bad is it?
It's definitely the major hurdle. You've got this double whammy, high prices, as we discussed, and significantly higher mortgage rates compared to a few years ago.
So it costs more to buy the house, and it costs more to borrow the money for it.
Exactly. And Bankrate gives a concrete example. Let's say you borrow $320,000. At the rate from early May 2025, around 6.82%, your principal and interest payment is about $2,090 a month.
Okay.
Now, just for comparison, if rates were up at 8%, that same loan amount would cost $2,348 a month.
Oof, that's over $250 difference per
Yeah.
month. That's huge.
It really adds up and can make or break affordability for a lot of families.
Yeah, absolutely. But the article also mentioned a potential downside if rates do eventually fall.
Ah, right, the flip side. If rates come down significantly, you could see a lot of buyers who've been waiting on the sidelines suddenly jump back in.
Unleashing pent-up demand.
Exactly. And if the supply of homes for sale is still low,
Mm-hmm.
well, that could just push prices up again. More competition.
So lower rates might not automatically mean cheaper housing overall if it sparks a bidding war. It's a real balancing act.
It really is. Kind of a catch-22.
Okay, so given this complex picture, high prices, higher rates, potential future shifts, what practical advice does the article offer for people trying to navigate this? For listeners thinking about buying or borrowing.
It boils down to being informed and strategic. First, they say keep a close eye on inflation. That's your best clue for where Treasury yields and mortgage rates might go next.
Monitor inflation. Got it.
Second, shop around aggressively for your mortgage. Compare lenders. Get quotes.
Don't just take the first offer.
Definitely not. The article suggests that since the refinance market is slow, lenders are competing more for purchase loans. So there might be deals to be had on rates or fees.
Okay, shop around. What else?
Be cautious with adjustable rate mortgages, ARMs.
Ah, the ones with the low introductory rate.
Yeah, they might look tempting with a slightly lower rate for the first few years, maybe 5 years or so. The article mentions the initial saving might only be around 0.5% right now.
Only 0.5%.
Yeah, not huge savings up front. But the risk is that your rate could go up significantly later on. And apparently, newer ARMs adjust more often now, like every 6 months, not annually like they used to.
Every 6 months. Wow, that adds risk. Okay, caution on ARMs. Anything else?
One last point for current homeowners thinking about renovations.
Yeah.
If you have a really low mortgage rate locked in from a few years ago.
Yeah, like those sub 3% rates.
Exactly. Don't necessarily rush to refinance that entire mortgage at today's much higher rates just to pull cash out. Consider a home equity loan or HELOC instead. Might be cheaper.
Good tip. Use home equity instead of ditching a great primary mortgage rate. Okay, that's some really solid, actionable advice there.
Hopefully helpful for folks trying to figure things out.
Definitely. So as we wrap up this deep dive, looking back at the Bankrate article and our chat, what's the single biggest takeaway you think listeners should hold on to?
I'd say the main thing is understanding that the Fed's influence on the housing market is indirect. It's powerful, sure, but it works primarily through those Treasury yields and then mortgage rates.
It's not a direct switch.
Right. And there are always other major economic forces, inflation, growth, supply, demand, all shaping what actually happens with home prices and sales. It's a complex interplay.
A complex interplay indeed. Which leads us to a final thought for you, our listener, to chew on. We've talked about how the housing market has historically weathered different interest rate storms. So thinking beyond just rates, what other deep-seated factors, maybe supply constraints, demographic shifts, construction trends, something else entirely, do you believe will be the most critical forces shaping where the housing market heads next?
That's a great question to ponder. Lots to consider there.
Definitely something to think about. Thanks for joining us for this deep dive.
My pleasure.
Well, that wraps up today's episode of Reality Reports, where real estate meets real life. For more updates, tools, and insights that will help you buy, rent, or invest with confidence, be sure to follow, subscribe, stay connected, stay informed,